Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Daniel, it's not uncommon for me to run across people when I'm doing a second opinion on their financial and retirement programs that I see them that they have multiple multiple accounts at multiple investment organizations. They might have three, four different large name or big name or any kind of name organizations, and then they have multiple accounts in with each organization, and then within each of those they have a bunch of typically mutual funds. And I asked them the question, why do you have so many organizations handling your money, and why do you have so many mutual funds? And their answer is, well, because I want to diversify. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about diversification. Is it important? Do you need it? Are you diversified? And that's a funny story, right? It's not a joke because we see it a lot, but
Right.
It's kind of a joke when somebody will say, well, I'm going to split my money between 4 advisors. And then you look at the firms the advisors work for, and you're like, oh,
They're all
they're
the
going to buy
same.
the same funds. So
Yeah.
you're like, maybe you're avoiding getting a Madoff by doing that. So there's
Maybe.
that type of thing, but your assets are not being diversified. And so there's a few different types of diversification. You like to talk about diversification of tax classes and investment vehicles. We did a show on central bank digital currencies.
Right.
And we talked about how you can protect yourself from the banking system by diversification. So this may kind of sort of be a follow-up to help people understand about diversification. And if they haven't listened to that show on central bank digital currencies, that's a good one to understand a little bit more about the leverage and the derivatives and the banking system. So
Right.
you can diversification should prevent you from correlation or from returns, right? So
Right.
people talk about the investment volatility. So if one thing's going up, one thing's going down, but it doesn't necessarily have to be everything going down together or up together. It could be diversification so that you're still earning. You need to always be earning something. So while things are coming down, you're still getting paid. You're still earning. So we'll dive into all these different types of diversification and hopefully make a nice congruent story, a nice congruent synopsis so people can understand if they're diversified, if they're not diversified, and if not, how to get diversified.
Right. And true diversification is what I like to call it, because people think, it's just like the story at the top of at the top, which, they think well, if I get a bunch of different advisors, I'll be diversified. And if and then they're going to invest myself in different stuff. But, they invest in a bunch of different mutual funds. So they're really not truly diversified. True diversification is having opposites. Right, Daniel? I mean, that's kind of like true diversification is about having non-correlated investments when we're talking investment diversification and such. Things that are not going to work in the same way. But when you have a bunch of mutual funds, they're all going to work in the same general direction, right? That where, like, what I like to say is that there's 3 basic kinds of diversification. People normally think of diversification in regard to investment diversification, like so much originally when investment diversification came out, was the idea of so much in stock, so much in individual bonds, so much in cash, so much in commodities or gold or whatnot. And the idea was there were different asset classes and each one acts differently. So sometimes when one is high, the other is low, or vice versa. And so that's true diversification when it comes to investments. The problem has become with investment diversification, especially with the 80s and the 90s when mutual funds became so prevalent and since then, that people put it's so much in stock, in growth mutual funds. so much in global mutual funds, so much in bond mutual funds, so much in short-term bond mutual funds, so much. It's basically all mutual funds. And so you don't get true diversification at that because they're all mutual funds. And the problem with all mutual funds is, or all stock market based investments like mutual funds are, is that when the tide goes out, all the ships go down. So when the market comes down, they're still going to come down. And you're not going to have, some may not come down as badly or as hard as others, and some may not go up as fast as others. So it's really a crazy thing. The second kind of diversification is tax diversification, meaning that some of the, most people have most of their money in tax deferred, pre-tax tax deferred investments, 401ks, IRAs, that kind of thing. But that's one form. And then there's tax free investing, and then there's tax after tax investing and tax preferred investing, all kinds of different ways. And then there's the diversification of strategies, performance versus purpose, accumulation versus distribution, growth versus income. These are strategies that are employed. And so if that is true, if you're truly diversified in each one of those categories, then you're going to have some really nice diversification. And I just need to let you know that you're listening to Financial Strategies with Andrew and Daniel Agemy. And because people don't know what people don't know. Today's topic is how diversification works, and do you need it? And we have a paper to go along with today's show, which is called Why Investing in Mutual Funds Could Jeopardize Your Retirement Plans. How many advisors does it take to ruin your financial or your retirement program? One. And it's important to be able to understand why investing in mutual funds could jeopardize your retirement plans. And they might have a piece in it, but typically people invest too much in mutual funds as far as I'm concerned. So we'd love to put this paper in your hand. Ask for it by name, call it Mutual Funds, 800-725-7616 for your free copy. Call now. Listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. We're talking about diversification, and we just went through the aspects of true diversification. There are three different kinds, being investment diversification, tax diversification, strategy diversification. The key is non-correlated investments, or non-correlated things, things that work against each other, right, Daniel? So what help us understand this non-correlated piece, because I think people don't get or understand the non-correlated piece.
Yeah, people a lot of times will take funds, ETFs, mutual funds, and they'll say, I'm diversified, I've got 20 different funds. And then you dive deeper into those funds and it's all stocks. So they own one asset class, they own stocks. And when there is a recession, when there's a market crash, when there's a panic, then all of these go the exact same way. They go down.
Right.
And if you need money, if you want money for buying opportunities, if you want to take advantage of some of the deals, then what do? You can't do anything, right?
Right.
Some people will say, well, then I keep some money in cash. And for the longest time, that was a difficult thing to do. It's always good to have cash available for buying opportunities, but for the longest time, it wasn't paying anything. So really,
Right.
there was a big opportunity cost for holding that cash. And now you can get paid 5% just to sit there and cash, which is a nice thing. You had to do a lot more work previously to do that. And some cash alternatives that people have used over time, over hundreds of years, that have worked really well are things like, cash value life insurance, right? This is outside the banking system, and it generates a tax-free or tax-deferred, depending how you use it, return.
Right.
And a lot more substantial than what people realize.
Right.
So when we look at breaking down asset classes, historically, as you mentioned before, it's not just stocks and it's not just bonds, right? There's a whole thing. You want cash, right?
Right.
And you want some You want some silver or gold or precious, but commodity exposure, right?
Right.
You need
Right.
your commodity exposure. And the S&P used to kind of do a good job of giving you exposure. It was all stocks, it was all
Right.
equities, but like there was a big energy set and a big tech.
Mm-hmm.
And there was commodity, but now like the commodity section, the miners, the precious metals is minuscule. The oil and gas, the energy exposure is minuscule, right? So like the S&P doesn't do what it used to do back when it was started.
Right.
It's just mostly tech, and it's all equity either way. So if you get that commodity, then real estate. Usually people have the real estate one all set because most of their money is in their house.
Yeah.
So typically people have that one set. But if you're talking about a lot of money, how are you diversified into real estate?
Right.
Not REITs,
Right.
right? Not
Real estate
REITs,
investment
because that's
trusts.
just
Right.
equity exposure. Yes, it's better than not having them at all.
Mm-hmm.
And if they're paying you, that's nice, right? If they're paying, but that's an equity again. So it's going to act just like all the other equities in your portfolio or the other equity mutual funds in your portfolio, right?
Right.
Bonds. And people will be like, bonds are just bonds. Well, bonds is another asset class, and there's all different types of bonds inside that bond universe. But not if you just buy bond funds, maybe it won't be quite as volatile as equities, but you
Right.
gave up what you buy bonds for. You
Yeah.
buy bonds
Definitely.
for the guarantees. You buy
For the
bonds
safety.
because
Yeah.
they're safe, and because you'll generate a return, and when those will be bought back from you. There's
Right.
contracts behind those, but you give that up if you put that into a fund. It also makes it just like a stock. It just
Right.
makes it volatile just like a stock. So we can dive more into all these things, but these are the asset classes people want to have exposure to, and not just through equity funds, not just through ETFs or mutual funds. And then alternatives. Alternatives is a bigger and bigger thing. Alternatives is a wonderful thing to have. So this might be some type of private equity. This might be venture capital. This might be angel investing. This might be cryptocurrencies, Bitcoin, things like that, right? The alternative investments. And if you get a nice diversified portfolio like this, what's going to end up happening if something's always doing well, it's going to bring down your risk. That's one thing people don't realize. It's not just a nice thing to say to be diversified, it lowers your risk tremendously. Um, and like I said, we can dive more into each of these things, but those are kind of the six things. People count cash, don't count cash sometimes. So five or six, depending if you're counting the cash, ways that you can have true diversification, at least
Yeah.
from an asset class perspective. This isn't talking what you were talking about the tax strategies or the vehicles of owning these things, but as
Right.
far as an asset class strategy.
Right, right. Good. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. We believe that an educated retiree is a happy and stress-free retiree. So today, in order to educate you, we've got a book that we'd love to be able to give away to you. And this is called Retirement Income Story by our friend David Scranton. And this is telling people and explaining how people can be able to have the retirement income that they need to last the rest of their life. We'd love to be able to put this in your hand because it involves diversification. And you can have it for the first five first time callers at 800 725 7616. No obligation, 800 725 7616. Call now.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
When I came into the business in the 1990s, I learned investing according to the way Wall Street wanted me to learn it, and so I started investing people's monies in mutual funds. And as time went on, they did okay, but then when the market started to drop in the year 2000. I started freaking out because my clients were losing money. They were freaking out. They didn't like it. I was like, what's going on here? Nobody ever taught me about, what happens when the market drops and how all these things. I mean, I have them in stock mutual funds. I have them in bond mutual funds, and but their money's still going down. What's the problem with this? They're diversified. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about diversification and do you need it? Um, Dad, so that sounds like pretty diversified.
Well,
Buy
I
a bunch
did
of
it.
funds. That's what they're
Yeah.
for, right?
Yeah, well, but I didn't know what I didn't know is the point. I listened to Wall Street's rhetoric and did things according to what they had, but I realized through the bad experiences that it wasn't the right way to do things, and my clients ended up losing all their money. So I changed how I did things in the early 2000s and changed my business model to be able to look at and read and study history in the market, true diversification, and what it really is. And now, I'm happy to say that our clients are able to go through sweet times when the market does have an effect, like it has right now. The market's down, but our clients typically are not down, and their incomes are up. I talked with a client yesterday that his income was up 12 or 13% from a year ago. That's fantastic. Um, during COVID, we were able to take advantage of true diversified portfolios that our clients have to put them in an even better position. So, the mistakes I made in the past, I learned from and to my clients' benefit today.
Yeah. When we're talking about diversification, there's a lot of different ways to measure it, right? So if we're talking about asset class diversification, um, this is where, you know, correlated is one, right? So non-correlated would be zero to one. So that means if your S&P goes down, your asset stays at zero. It doesn't move. Negatively correlated would mean it actually went up, right? And so when you're talking about clients who, when the markets are down, they're typically not, they would have a zero correlation or maybe a negative correlation where those accounts are either flat or maybe they went up a little bit. Um,
Right.
People get confused with diversification really easily
Right.
because typically what happens is what you call, right, the disease of ease,
Right.
where instead of having to do individual research on individual companies, um, people end up just saying, well, I'll buy the fund, I'll buy it all. And that way we don't have to do research, we'll just buy the fund. And the difficulty is you're not getting real diversification here. It's it may feel good because you own everything or you own everything in this asset class. Um, but as we know in life, easy things are not always the best,
Right.
right? Um, it's easy to sit on the couch and watch TV, but if you're worried about your health, that's not the best thing you can do for your health, right?
Right.
You need to
Right.
go do some exercise, you need to go work out, and this will allow you to have better life, better
Right.
health. It's the
Right.
same with diversification. Just because that's easy doesn't mean it's best for you or for your portfolio.
Mhm. Right, right. And there's a lot of things that are easy when it comes to investing because it's meant to be easy for the advisor. It's meant to be easy for the client. I mean, 401k plans with, they give you a lot of choices and they say, hey, when are you going to retire? Well, I'm going to retire in 2030. We'll go into the plan, the 2030 mutual fund. And, that can be actually disastrous to you. And we have a paper to be able to help you understand that a little bit more that we'd love to give you today. It's called Why Investing in Mutual Funds Could Jeopardize Your Retirement Plans. And we love to put this in your hand for free. Ask for it by name, call it mutual funds, and we can have it by calling 800 725 7616. 800 725 7616 for your free copy of mutual funds and how it could jeopardize your retirement plans. You're listening to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. We believe that an educated retiree is a happy and stress-free retiree. Today, we're talking about diversification and how it works and what true diversification is. Daniel, as we look at this diversification and people think, well, I'm going to have so much money in the banks, and like our show that we did on central bank currencies, digital currencies, and such, talked about how you need to have maybe in different local banks or maybe some money in gold, some money in silver, some digital currencies that you have in a hard wallet, various things like that, and those are all that's another form of non-correlated investments. Um, um, what do you have to add to that?
Well, yeah, a lot of people will say, I've got cash, I've got, $2 million in the bank. And that is a tremendous risk. People think the banks are safe because they trust the banks. Um, but when you put your money in the bank, there's not a contract. It's not your money any longer.
Yeah,
As soon as it goes into the bank,
that's
it's the
crazy.
bank's money. If they lose the money, you lost your money. Now, there's this thing called FDIC insurance. And this is
Hmm.
why people have so much faith in the banking system. But the
Right.
difficulty is it's only for $250,000. And for a lot of people, that covers the money in the bank. But for a lot of people, they have far more than $250,000 in the bank. And your money is far more risky than you think it is.
Hmm.
Um, you know, when the way that banks are currently leveraged is mind blowing. Okay. And because this is their money, when they go bust, your money will go into what's called a bail in, and it will bail in the bank instead of taxpayers paying for it like in 2008 when the bank got bailed out. What is set up to happen now is there will be a bail in. So your money over that $250,000 limit is going to bail the bank in, and you'll get something in return for your money. But what will it be worth? You'll get a bankrupt bank stock, maybe, or maybe you'll get a central bank digital currency. Who knows what you'll get? But the point is, you need to understand if the money's in the bank, you're taking the risk of the bank. Now, there's other alternatives that may be safer. And if you're using bank as like a cash alternative, right? You can
Right.
do other things. Like you mentioned, you could split it up between smaller credit unions or smaller banks because it's these globally important banks that are the ones that are really doing the derivatives and the things to watch out for. You could use insurance companies. In the Great Depression, it was something like 38% of banks went bad,
Wow.
where we have not been able to find someone that lost their money because an insurance company went bad. There was
Yeah, just the
consolidation
opposite.
in the insurance
Hmm.
company industry, but I have not been able to find any that actually went bad. So that's a cash alternative that's worked well, and um, that's a way to have cash and cash available to you in emergency. Somebody will be like, I bought some gold, or I have this insurance policy, and there are bad policies, so you have to watch
Yeah,
out for that. But I
definitely
have
have to
this
watch.
it only earns 4%. It only earns 6%. Um, you can't compare performance
Yeah.
when you're talking about diversification. So you're earning 4 to 6%. You can't compare that to the stock market because what's your downside,
Yeah.
right?
Yeah.
Well, they're taking on the risk, and you get a globally diversified portfolio. These insurance companies understand diversification, and they have the money to diversify properly, right? They might
Right.
own they might own hotels throughout the world, not
Right.
ETFs of hotels. They own the hotel, right? They own land. They own alternatives that you wouldn't be able to buy, right?
Right. Yeah.
Like these deals that are not available to you. So you're getting diversification inside of this, not by a mutual fund salesman clicking a button and buying you a mutual fund and saying you're diversified. So through the cash portion, this can be a cash alternative for you to have this money because it's the correlation to the market is zero.
Right.
When the market goes down, you stay the same. Now you could
Right.
get a fixed where you'd still go up, but
Yeah.
like the correlation is zero. What does this allow you to do? Well, if you look at Apple stock right now, trading at 35, 40 PE, ridiculous. Do you know what that
Yeah.
means?
Well, I do to
What
tell
does it
the
mean? Tell
audience.
us what
Yeah.
it means.
Well, if it's a 40, a 40 PE, then it means that it's going to take 40 years to get your money back. So if you invested, $100,000 in it, it's going to take you 40 years to get the income back from that to be able to generate to make it worth your while. So, I mean, I like to use it in relation to, the ice cream store, right? Local ice cream store, and people look at the ice cream store and say, "Hey, I want to buy that ice cream store. How much, how much do you make a year?" And they say, "Well, I make $100,000 a year." Well, how much do you want for it? $3 million. Well, you better run out of that place and hold on to your wallet, right? Because it's going to take you 30 years at $100,000 a year profit to be able to get back your money, let alone make anything on it. You'd be better putting it off in treasuries at 3, 4, 5% for that 30 years. You'd be far ahead from that standpoint.
And that's the whole point of diversification. People think you have to buy that equity.
Right.
They wouldn't buy the ice cream store you just talked about, but they think they
Right.
have to buy Apple, or they have to buy these equities because they've been going up. But that's what you could still own it, even though it's outrageously expensive.
Yeah.
But then you have the other thing that's not doing anything, the gold that hasn't done anything for 10 years, or the insurance company that's only earning 4 to 6%. You
Right.
have that. So when the Apple or the equity market comes back to a reasonable valuation, the 8 times earning that it typically is, or the 8 times, the 6 times earnings that it is on a good deal, you have money that was only earning you 4%, but it didn't go down 60%,
Right.
and you can participate in that. That's real diversification.
Exactly. You're listening to Financial Strategies with Andrew and Daniel Agemy. It's time for us to take a break, but before we do, we want to give you this book as we talk about diversification. This book is called Retirement Income Story by David Scranton, which will be able to help you to be able to understand how to have a stress-free retirement, diversifying and being able to make sure that you're educated so that you can make smart decisions. Call now at 800-725-7616 for your free copy. The first 5 first-time callers at 800-725-7616. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
Okay, so I have a riddle for you in our listening audience. And the riddle is, when is zero return on your money a great deal? And the answer is, when the rest of your assets are going down and losing money. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about how diversification works and if you need it. And today may be a little bit different than normal, but it's thought experiments, people to challenge their belief systems and challenge the way that they see diversification. Wall Street, the banking system, right,
Yeah.
has it's been gamified, but it's
Indoctrinated.
also been simplified to just, you buy this fund and now you're diversified. But when we're talking about the benefits of diversification, that's not really how it works. Diversification needs to respond differently to events than everything else that you own. Otherwise, it's not diversified. It's the same. If it
Yeah.
all responds the same, it's the
Yeah.
same.
It's the same. Yeah. Yep. Yeah. And that's the thing is that it's preserving your money is well worthwhile. The whole aspect, they say investing is easy, but it's not simple, right? Well, the whole concept behind investing and behind business, generally speaking, is buy low, sell high. And but in order to do that, when your assets come down, and my riddle at the beginning of the show, I said, when is there a return a very good return? It's, well, when everything else is going down, because if you didn't lose anything, it's like selling high, so that then you can take that and you can buy more of what has gone down in value, so that when it comes back, you can take advantage of that growth aspect. But most people are invested in aggressive things, so that when it comes, they're all invested in the same thing because they're not diversified. So when something happens to it, they have no money to be able to buy low. I mean, everybody will understand and agree. Yeah, I want to buy low and I want to sell high. But if you don't have any money to buy when it's low, what good is that? So that's why a non-correlated a truly diversified portfolio is an important thing to have.
Yeah. And partly why, besides the simplification of we just have funds and you can get diversified from these funds. Besides what we've talked about previously of the fees that Wall Street, the fees that these huge investment companies get by keeping people in these funds for long periods of time. Besides those, why this is happening is because um, the U.S. equity market has outperformed most things over the last couple of decades. Now, if you are someone who has invested in these things, you've made a lot of money over the last decade. You've made a lot of money. And something you mentioned a little bit ago is it's not just about making money, it's protecting. So you've made a lot of money and you look around and you say, um, by every metric by every metric I can use, these asset classes, US stocks look expensive. If we're talking in 2021, you could take, you sold your business, you sold your equity portfolio because you thought it was expensive. You put it into a 2-year treasury bond, you make $15,000 a year, right? This does not sound very attractive. You really have to want to protect yourself to do that, right?
Right.
Well, now you take that $10 million, you make $500,000 a year.
Right.
It's the same 2-year treasury. It's just where rates have gone. Now you say, does buying a company for 30, 40 times earnings still make sense if I can just put it in the safest asset on earth and earn, that's a pretty good
I know
living, right?
times that.
500
Yeah.
million or
Yeah.
$500,000 a year, right?
Right.
Just to
Right.
sit and be patient and wait for those opportunities. The
Right.
game has really changed. And so if you are someone who's just sold a business and you've got $10 million sitting around, you're not sure what to do with, or you are someone who's made a lot of money in markets over the last decade, don't keep gambling,
Right.
right?
Right.
You get paid to be patient. You can get paid to sit back and wait for the opportunities that you didn't get paid for in the past.
Yeah. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is diversification. Do you need it? What is true diversification? And we are glad to be able to bring you a paper that goes along with this, which is the importance of financial defense. And it's something that people don't usually think about, but this is a short paper. It's about 3 pages long that will help you understand how to diversify your money in a way that perhaps you have not thought before. Most people don't think in these fashions. And we love to put that in your hand. Call 800 725 7616 for your complimentary copy. Um, uh, and just ask for it by name, called Financial Defense. Call now at 800 725 7616. You're listening to Financial Strategies because people don't know what people don't know. Daniel, the one of the things you're talking about just then in regard to, buying a company at 30 or 40, a PE of 30 and 40, and or buying the treasury and getting a 5% interest. One of the other aspects that with that is the difference between um, growth versus income, or purpose versus performance in those two scenarios. Because the one of buying the stock at 40 at a 30 or 40 PE, well, the only way you're going to make money on that stock is, let's say you buy it at $50 a share, is if it goes to $55 a share, $60 a share, $70 a share, and you sell it at that point. But with a ratio of 30 to 40, the chances of that happening are not very good. So people don't get this. Whereas the example of the treasuries at 5%, and you said, on $1 million, that's $50,000 a year, and that's coming in every year. That's true interest that you can either spend it or you can reinvest it or whatever, and you're actually getting something from it. So that is real key, because in that example, you have not only have you not lost anything, but you're still getting paid. And when you take that stuff and you get paid when everything else is down like it is right now, well, you got purchasing power where you're buying low, so that when it comes back, you'll be able to sell high, or be able to gain extra value at that point. And we did this a lot. We're doing this a lot right now with our clients, because we have clients who are in negatively correlated or non-correlated investments where they haven't lost any money, even though the market's down. That's why we can tout how our clients have, if they've lost anything, it's maybe 1 or 2 or 3% at this point. But yet their income has gone up a 10% plus, double digit. Because we're taken from that which has not had any loss, and buying that which has loss, so that we can, the analogy I like to use is we're buying skinny chickens that are on steroids, right? So now their eggs, instead of being 5% eggs, they're 6, 7, 8, 9% eggs, and then the chicken comes back to full size at some point in time. So this is a huge thing, and we did it. We did it during COVID. And we did it in December of 2018 when the stock market dropped 25%. This is a methodology that we use to and this is why we believe so much in true diversification.
Yeah, absolutely. And we like income, right? Think about a generator. If you've got a generator and you've got unlimited gas for your generator, are you worried about turning the lights on? Are you worried about running out of power? No, because
No.
you know that generators, they're pumping and generating that for you. It gives you a lot of freedom. If you got somebody out there pumping something, or hoping that the lights are going to stay on, right?
Right.
Um, hoping that it doesn't get cloudy. You got solar out there and you're just hoping it doesn't get cloudy, or there's a snowstorm coming, so you know that it's going to get covered in snow and the power is going to go out. It changes the way you see things.
Yeah.
And that's why we like these. And the cool thing is, a lot of this diversification will pay you now.
Right.
There are, like we just talked about cash. We talked about a bunch of different ways you can invest in cash or cash-like instruments where your money it's not volatile. It's there, it's cash, it's available for you for buying opportunities, and it's paying you right now, whether that be the insurance companies, the cash value life insurance, the treasury bonds, these cash or cash-like instruments are a really good way of generating income right now. Um, the real estate we didn't get into, but we like real estate that pays you, right? We use that example all the time.
Right.
You buy an investment property. Now, the difficulty is a lot of retirees don't want to have to deal with being a landlord. And
Right.
so there's ways that you can generate income without doing that. But that's another one. It doesn't matter what's going on in the markets, as long as you
Yeah.
have the good tenant. Um,
Yeah.
You've got you've got a contract behind that, and you're going to get this income coming in. That
Right.
the price of the asset doesn't matter so much
Mm-hmm.
if it's going up or down, because you're getting paid, and you can get paid to wait for it to get back to the pricing. And people
Right.
always say real estate does well over time, and that's partly because the thing you're valuing it in is going down every year, right?
Right. The
The
value of the
dollars
dollar.
you're
Yeah.
valuing the real estate in is going down. Now, houses aren't typically that great of investments. People say they are,
Right.
but they're typically not, because you put so much money into it every year. You pay the taxes, you do all these things. If you
Yeah.
actually calculated what you're earning, it's not very good.
No.
But it's keeping your purchasing power, and that's what makes people happy, because as that thing they're measuring, it goes down every year. They're
Right.
saying, look at all this money I made, but it's kind of just keeping up with inflation. So it's better than having the money sitting doing nothing,
Yeah.
but it's not so much an investment. It's more like you can write it off. It's good to have a place to live. That's great. And that's all you need it to be, is I
Right.
have a place to live.
Right.
Um, Whereas if you own the real estate properties that are paying you, this is cash flow. You get to do whatever you want with the money. Spend it, reinvest it in good opportunities, give it
Yeah.
away, whatever you want to do with it. Buy more, right? Buy more
Yeah.
real estate and let it compound. These are why we're always talking about income, because you get paid no matter what's going on. Um, and the pricing doesn't matter so much when you're getting paid as it does if you just own an equity fund and it
Right.
goes down and that's all your money. And now
Now
what are you
what?
going to do until
Yeah.
it comes back? If it comes back, because you've
Right.
seen
Yeah.
equity funds never
Not
come
come
back.
back. That's right. I have. That's right. Yeah, that's good stuff, Daniel. And one of the things, if you're a real estate investor listening to our show and have property, it's not uncommon for us to meet people like you who are tired of doing it. That you actually want to retire from investing in real estate, and so we can create the same passive income for you through other methodologies, and that you can just sit back and collect a check. So, and many times it's at a similar rate as what you're doing these days with your real estate. So, keep that in mind. But if you just joined us, you're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is diversification and the importance of it and what is true diversification. We have a book that we'd like to give you to be able to help you understand how you can have a stress-free retirement, because we believe that a educated retiree is a happy and stress-free retiree. This week's book is Retirement Income Story, and how retirement income can make or break you, right? If you have the income, you can live the rest of your life with all the money that you need to be able to do what you want to do. But if you're not invested for income, well, now it becomes a different story. And you can have that by calling 800 725 7616 for your free copy. The first 5 callers at 800 725 7616. Call now.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
Yeah, Peter and Amy came into some money. They had about $10 million, and they said, we need to get some advice on what to do with our money. So they went and they went to a big name financial firm, and the guy says, equities always go up. You need to invest, you know, 90 to 100% of your money in these equities. Equities are the best thing you could do. It's the best inflation hedge. It's the best way to make money. You'll never go wrong in the long term. And they said, that doesn't feel right. Let's go. So they went down, and they, on the way home, they see a commodities expert. And they say, let's go talk to him. So they walk in and they go and they sit down, and he's a real nice guy. And Amy says, so how do you think we should invest our money? And he says, the whole world is ending. There's only one thing to do with your money. You need to buy gold, physical gold that you can keep in a vault and ride your bicycle to. So when airplanes don't work, you can ride your bike and go get your gold. And Amy says, I'm not sure about that. So they go and they talk to their real estate friend. And the real estate friend says to them, you know what? Those guys don't know what they're talking about. Real estate is the best asset you can buy. You just need to build a diversified real estate portfolio. Buy some houses, buy some rental properties, just buy real estate. It's the best inflation hedge. You'll be okay. And Peter goes, I know some people that lost money doing real estate. I'm not sure that that's right for us either. And they're thinking, there must be a better way to do this. So they go down the street, and their friend, the real estate friend, had told them about somebody he knew who was a specialist in alternatives. And he said, maybe you should put, 4 or 5% of their money in alternatives. And you don't want to put it all in real estate. That'd be crazy. So they go and they talk to the alternative guys. And he said, this is the best performing asset of all time. Alternatives are the way to go. Now, you won't be able to get your money out. We don't know if you'll ever be able to get it out, but this is the way to go. They just go up. There's no volatility for them. This is the way to go. And so they're getting kind of discouraged. They go home and they're sitting and they're talking to their father-in-law, and he says, "You know what? I don't trust any of those people. What you need to do is put it in the bank. The bank cash, you can get it whenever you need it. This is the way to go." I'm Daniel Agemy.
And I'm Andrew Agemy. Listen to Financial Strategies with Andrew and Daniel Agemy. This is not a comedy show. We do this because people don't know what people don't know. We want to educate you and help you be able to understand, because an educated retiree is a happy and stress-free retiree. Daniel, today's topic is diversification and true diversification. Do you have it? Do you need it? What is involved with it? Daniel, that, as you can tell, I'm just rolling with laughter here in regard to your story, because I think it's just so funny going around to different people. Everybody's got their own view, right? And they're saying all the other people are wrong. And that is so often the case in this world, where people say, I'm right and everybody else is wrong. And because of that, it's one way or the other. It's my way or the highway. But that's not what true diversification is about it at all.
Exactly. And typically people won't go around to those different experts. What they do is they just go to, annuity sales guys,
Yeah.
Mutual fund sales people who just they have one thing that they're good at, or one
Right.
thing that they can sell. It's
Right.
mutual funds, it's annuities.
Right.
And the problem is, um, you know, that's all they know. And they do well if they did what Peter and Amy did and get these experts in these different fields. The only difficulty is you don't want to do the 90% or whatever each of these experts say.
Right.
Do 20%, or the part that you feel is that right amount. For everything's probability weighted. So if you think that the banking system is going to fail in the next X amount of time, you put the probability. If you think that's a 90% chance, then you shouldn't have more than 10% of your money in the bank, right?
Right.
That's
Right.
that. So you have to weigh it. But if you had a nice diversified portfolio, 20%, 20%, 20% into these different asset classes, and you use the expert to help you on that 20%,
Right.
that's diversification. Not going to three annuity salesmen and they all sell you an annuity. That's not
Right.
diversification.
Right.
Or
Yeah.
three mutual fund salesmen that all sell
Right.
you equity mutual funds, right?
Right. Yeah.
And that's what we're trying to get the point across here is true diversification is being in these completely different asset classes with experts that understand how each of them work, and they spend their life studying them, right?
Yeah.
Not just put
Exactly.
you in a fund that may have some exposure to that thing.
Right. Right. And you know, diversification is key. And I can't do a show on diversification without bringing up Ecclesiastes 11:1 and 2. It says, cast your bread upon the water, after many days it will come back to you, give it unto seven portions, even eight, for you don't know what disaster will come upon the land. And those are 7 8 different ways. It's non-correlated ways of investing your money, and you'll get it back in the future. Maybe one won't come back. Well, if the other ones do well, then you're in good shape from that standpoint. And this is Solomon, wisest man that has ever walked on this earth, that says this. And if the wisest wise guy can say this, it must be something for us to be able to take into consideration, right? So you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is diversification, true diversification. What is it? How do I need it? Well, we have a paper to go along with today's show, because it's called The Importance of Financial Defense. And part of diversification is having a defensive plan, not just offensive. And too many times, like Daniel's talked about, people are putting you in aggressive or stock or equity funds or accounts that are aggressive by nature, and they're offensive, they're not defensive. You need to be defensive. And that is a very important thing. This paper will tell you more about it. It's a 3-page paper. We love to put it in your hands. Ask for it by name, Financial Defense. Call now, 800-725-7616, 800-725-7616. Daniel, this aspect, we just got a few minutes left in the show today, and I think it's been good. I think we've been able to explain people these things. It's, in my mind, it's key what we've been able to do for our clients when, during, for instance, COVID, when the market came down, and we were able to take from those things that didn't go down and buy things that were down, so that they could, when the market came back a few months later, they were able to take advantage of that. That's what we're doing now. What do you say to the audience here in the few minutes we have left in the show?
Yeah, I think that that understanding these different asset classes and then seeing if you have a portion of your portfolio allocated to these. And now it changes. It's not static. You shouldn't just have like put 20% into each of these. And I mean, that would work. You could put 20% into each of these and just let it go forever. But you can trade around the position. So when if equities are at all-time highs, maybe and you don't want to completely get out of equities, take it from the 20% it is down to a 10% exposure, and maybe you put it in gold because right now gold is sitting there. Now, we don't like gold as much as other people do, and that's because it doesn't pay you, right? You could buy
Mm-hmm.
mining stocks that might pay. You could do different things. We
Yeah.
believe you should have exposure to gold, but clearly we like things that are paying people. We work with retirees,
Right.
and a rock sitting in your portfolio is a nice diversification. But if it's not paying you, you don't want to have a job, get a job so you can pay the bills because your gold's not paying you enough. So it depends on
Right.
how much money you have. But maybe you're putting it into gold. Maybe you're putting it into treasuries right now. You're taking that
Yeah.
extra percent of the equity portfolio because we're at all-time highs, and you're putting that into the treasuries. And there's been times where the Dow is down so much, right? Historically, where it's got an average 4 PE, 4 times earnings, and paying a 6 or 7% dividend. That's when you'd want to go heavier in the equity
Yeah.
portion. You pull the money out of the treasury or you pull the money out of the gold and you put it into the equities at that point, but not when they're too expensive. So we're not perma anything. It's what's paying, what's making the most sense, what has the most risk reward. Same with the gold pro. It's done nothing for 10 years. But in the 70s, it went from what, like $100, $300 an ounce up to 2000, right? It's had periods where it just goes crazy for that time. So that's why you can't always be out of these things, because you never know when that's going to take off. But you can probability weight it to the ones that you know are better priced than other ones, and that's based on the macro environment. That's based on what central banks are doing. That's based on your age, your risk for how much risk do you want to take, and it's based on your needs. What do you want your retirement to look like, right? Because we always say that you can't have too much income in
Right.
retirement. So the more of these you wait that are paying you,
Yeah.
the more stress free, the less stress you will have in your retirement. Because if
Right.
you have too much income, that either means you have more investment opportunities, you get to give more money away, or you get to go do more things, right? That's
Yeah.
the only
Right.
thing that too much income means.
Right. Yeah, well, and what you're saying is, sell high, buy low, peel off some of the growth, buy the stuff that's lower to be able to reposition and rebalance your accounts to where it can actually work for you again. I can't tell you how many times people say, I'm a conservative investor. I want 90% of my money conservative and 10% at risk, and they're actually the opposite way around. So little diversification, and what they do have is in the wrong stuff. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been diversification. Do I need it? What is it? What is true diversification? And I think, done a good job of being able to explain that to people and educate you, because an educated retiree is a happy and stress-free retirement. We are hoping that you're going to be stress-free in 23. We want to give you this book to educate you further, which is, a retirement income story by David Scranton. It's got a lot of alphabet soup after his name, but David Scranton's a friend and partner of mine in regard to helping people retire and stay retired. And he's got some great info in this book. It's an easy read book to be able to help you to understand how to diversify and how to be able to get the income that you need to be able to last the rest of your life. More than enough income to last the rest of your life. You can have that for free by calling 800-725-7616. 800-725-7616. The first 5 first-time callers will get this book for free. 800-725-7616. And you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. An educated retiree is a happy and stress-free retiree.